Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today, I'm going to take a break from my normal individual stock analysis and talk a little bit more about macro and also kind of just general portfolio management. For those of you that watch the channel a lot, I normally do individual stock analysis. Every now and then, I chime in with something that's kind of outside that. And I was getting ready to kind of put out a bunch of videos. I'm going to try to basically double the number of videos that I'm putting out because I have so many requests right now. And there's so many things that are moving kind of fast that I think I need to just to keep up with everything. But before I do that, I want to kind of give some broader context about how I'm thinking about it. Because really what I do is share what I'm doing. All right. So I'm not really telling anybody else, what to do. And everything, you can't really isolate an individual stock very much from the macroeconomy, the industry, global politics sometimes. And I want to provide this context so that people understand kind of the position that I'm working from, because it can be very different from investor to investor. And I want to kind of give that context, and the most important part about it is really how much cash a person has. So to me, cash is king. And in the full Cyclical Investors Club service, our cash and my personal cash, most of it is in short-term floating rate US Treasuries. So TFLO, TFLO, that's an ETF. That ticker is floating rate Treasury, short-term floating rate Treasuries. The average duration is about a year. And it's yielded around 5% the past couple years since we've owned it, in between 4 and 5%, 4 and 5.5%. So when I say cash, in terms of investing cash, that's what I'm referring to. It's cash that you want to buy stocks with if you can buy the stocks at the right valuations, at the right price, and they come up, the market gives you an opportunity to buy them like that. So that's where money hangs out, that I want to buy quality long-term businesses via the stock market with. And so that's one type of cash and that's usually what I'm talking about when I make videos. But we're kind of in a situation now where I need to kind of zoom out even a little bit farther and talk about things that can affect your investments, but that are not specifically earmarked for investment. So I just want to make sure people understand that they need to have other things in order. I'm not trying to tell anybody like what to do. This isn't individual investing advice. This is like personal, it's like personal finance, which I don't really get into because I'm not a personal finance advisor, but it's important for the context of the investments, right? Because if you went through, as an adult and an investor, I've gone through technically 3 recessions now. 2 of them combined were the worst since the Great Depression. And so I've viscerally experienced things as an investor and just as a citizen and person who's in the labor market and so forth, and business market, that a lot of people aren't going to be familiar with personally, right? If they haven't really experienced that before. So I had the dot-com bust and the recession that followed, the Great Recession, the Great Financial Crisis, and then of course we had the little kind of short recession from COVID. And I'm a little bit of kind of a prepper, sort of. That's a kind of my mindset. It's just to give you like where my mindset's at. I want to be prepared for most things that can reasonably happen in the market and in the economy, right? Because what happened during the financial crisis especially was that people lost their jobs, so they had to take their things like their 401k. Sometimes they lost their homes. They had to take money from the 401k to live. It wasn't that people got scared. Well, people did get scared and sell their stock holdings, but that wasn't just it. That wasn't the only thing. People needed to do that to like buy food, to pay rent, to do the normal. So when we get into situations like that, you need to be really that affects your investments, right? You're a forced seller during times when the market is really cheap, potentially, or at least not fully valued to what it would be during a normal time. And you need to take steps in your personal finances to make sure to try to, I mean, nobody can control everything, but you can try to make sure that you're at least somewhat prepared for that. I mean, sometimes the main thing is just knowing that it can happen, right? Because so now in the US, basically, so here's the thing. I don't want to be like political on this channel. It's really not, because this is the same position that I've had since January of 2022. I've basically been preaching the same thing. And we saw it happen with the market. I'll kind of go to the fast graph here during this 2022 sell-off, right? So the market was down like 25% or so, maybe even a little more than that. And I started talking about this in late December, and then I wrote articles in January. And I think it could have been worse than what it was, but we had, market-wise, we had big cuts, like deep cuts in big tech, labor-wise. And that saved, and just expense-wise. And that saved them a bunch of money. They were able to cut a lot deeper than I thought. And so their earnings were able to rebound. And then we combine that with kind of AI enthusiasm. And when you put those two things together, the market really took off. And so it looks like, but that hasn't necessarily translated. Let's go. So let's look at the earnings growth since here for the S&P 500. We had 5% earnings growth in 2022, none in 2023, and 9% last year. Okay, so that's 14% earnings growth. That's like what the inflation was. That's what inflation has been. Okay, so we've had 3 years with no earnings growth. Most companies, when I look at them, if I look at like an equal weight S&P 500, I didn't check the SPY, which is what's up here. I didn't check to see where it was. They're barely above inflation since 2022. So we've already been experiencing some of these headwinds, right? This isn't really anything new. And it's just been masked by stock market kind of enthusiasm, mostly for AI. And it's important for people to keep that in mind. So I actually haven't changed. By the time we got into about halfway through 2022 in the Cyclical Investors Club, we had like over 30% cash. Right now we have about 40%, and that's T-flow, what I talked about earlier, cash that I want to invest. And it's been that way, and we started doing that at the beginning of 2022 and accelerated it with the Russian invasion of Ukraine. Because all these risks became more elevated. We also had student loans that started to be repaid back, right? So that's a drag on the economy. We also had, and we haven't even, I think maybe next month we'll get the data, if we can get data still, on delinquencies for student loans. They haven't been, Biden stopped the reporting of that basically to the credit bureaus. So I checked it last week, and they still didn't have any data for how many people are delinquent, like 90 days delinquent on their student loans. So maybe we'll get that soon by the end of this first quarter. But credit card delinquencies are where they were in 2008. They're like over 11%, like 90 days delinquent. These are not signs of like a strong economy. And all this has been going on since the start of 2022, basically. It's just kind of been masked because we've had inflation, right? So when you have 13% or 14% inflation, and the stock market grows earnings 13 or 14%, it looks like there is 13 or 14% growth. It was just not real, right? So companies haven't earned, the best companies in the world, basically, on SPY here, that, not including like buybacks and stuff. I didn't even back those out. They haven't been growing earnings any faster than inflation. So there's not any growth there. So this is the situation that we're in. This is why I've been cautious. I've had my recession mode metrics on since the beginning, basically since like first quarter, second quarter 2022. I sold off most of my deeply cyclical businesses. I don't own very many financials. And that all happened back in 2022, and none of that has really changed. I mean, there are individual stocks I purchased because they fell so much, like 65% off their highs, but that's because I sold all that stuff back in 2022. Now we get in the habit of trying to make predictions. I'm really more about preparation than predictions. So I don't want to be super surprised by something, especially if it's going to make me panic and do anything dumb. And the best way to do that is to have cash. So to get to the point that I'm aiming for here, right now we have a lot of changes going on. There are a lot of people losing their jobs. We don't know how that's going to play out, but the fundamental problem is, and this goes no matter how you think about politics or anything, is we're cutting federal spending that's going almost probably like 90% into the U.S. economy. Okay, so we're cutting that, and the idea is we're going to get growth from tax cuts, but there's a mismatch of the timing, right? So these spending cuts are happening so fast and directly to people's wages, right? They're happening so quick, and it doesn't look like they're ending, like it's full steam ahead, right? So that's happening now. That's going to directly affect the economy over the next 6 months or so. And the benefits are later. Like, even if you think all the benefits are coming, I mean, a lot of the tax cuts are already in place. So those are not going to improve anything. You're just trying to make it not get worse by having taxes go up at the same time the spending into the economy is going down. So that creates a lot of risk. And there are a lot of second level, third level effects that people just are not even like really thinking about. And I don't know exactly what they're going to be, but I know that for a large number of people, if 11% of people are 90 days delinquent on their credit card payments, we don't know what student loan delinquency is going to be. If I had to guess, it could be like 15%, something like that. Basically, you have people, they're going broke, right? They're slowly going broke. And credit is going to get tighter once these defaults work their way through. This is more like Great Recession type stuff. And what happens is credit will get tighter. It'll be harder to invest. So far, the 10-year Treasury rate has kind of hovering around that 4.5%. And it looks like the administration is doing everything they can to try to keep it low. But that's going to be a real kind of pivot point on whether things can really tumble down the wrong direction. So all those effects are going to work their way into the economy before any of the benefits. All right, it doesn't even matter if you agree with the benefits. It doesn't really matter. The timing of them is not going to happen at the same time, unless they start cutting checks, and then that's like a whole other thing, which they probably will, because otherwise we're probably going into a recession. But the point is, there's going to be a lot of volatility here, and a lot of volatility in people's personal incomes, right? That there's a lot of people that are going to panic, that are going to freak out. Whether they should or not doesn't matter, right? And what are they going to do? Well, they're not going to keep a bunch of money in the S&P 500. I mean, once the S&P 500 falls 10 or 15 or 20%, people are going to freak out, and they're going to pull their money out. And you need to be prepared for that, okay? And then at the personal level, what I want to make sure is people have their emergency savings built up first before they're buying anything that I start buying. Because when I have like 40% cash, and I'm going to buy some things on the way down based on valuation, and I'll probably buy some things on when the bottom comes in and momentum looks good on the upside. That's my basic strategy going on here. That's probably how it's going to play out. And hopefully that keeps me rational during whatever happens, And in the meantime, I'm collecting like 4.5% on the cash. So it's not too bad. So that's how I'm doing it. But you don't want your personal finances to be so risky that you have to sell your stocks even though you want to be buying. Like, you want to be buying, but you have to use the money for something else. So it's much more important to pay down any high interest debt, especially if it's like floating rate, build up an emergency fund. Like if a person makes regular contributions into like an IRA, it would be totally fine to put that money in an emergency fund first this year, and then toward the end of the year, if no emergency happens, then you can move it, move it into the investment account. I mean, I think that's a pretty good strategy. Now, obviously, each situation, if you're sitting on piles of cash at home or whatever, it doesn't matter. You're not who I'm talking to. Most people probably aren't like that. So have the emergency savings, just like every financial advisor says, maybe have a little bit more. And part of the reason you want that is because if the market does freak out and does fall a lot, you don't want to be worried about your personal finances and trying to be rational buying stocks in the stock market at the same time. It's really hard to do. If you know you have your personal end taken care of for 6 months or something, that can help you have the courage when everybody else is freaking out to steadily, methodically buy good businesses. I've seen this 3 times before now in my life, and I'm not predicting that the market's going to fall such and such amount, but the overall context is such that you want to be prepared to do what's rational if that happens, right? Over the medium and over the long term. And we'll have more information about how the shape of it, what it looks like as it's happening. But for me, the general thing is have the cash. I think for most people, 30% cash, this is for investing, to 60%, which is kind of what I have, like 401k allocation right now, cash, like, or short-term bonds or whatever, cash equivalent. I would definitely stay away from long-term government bonds, which I've said this for years. I mean, don't touch them. Just don't do it. It's just not worth it. There's too much risk there for inflation, for devaluation, for all kinds of stuff. In terms of emergency cash, I don't like precious metals in investment accounts, but if you think of the real reason you might want to have some, that's like an emergency cash type of bucket, right? And again, each person's individual situation varies there. So, but I'm not against it. But you're probably not going to see me making videos buying gold or whatever. Because I'm thinking investments. I want to buy growing businesses that can navigate this. If I can get them at good prices, that's what I want to do. And I think that's really all I have to say. A good, just across the board, if I was just going to put a broadcast number out there, 50% in an investment account, 50% cash, like T-Flow, short-term treasuries, 50% equal weighted S&P 500, tickers RSP. That's a base to work from. It's not going to probably do anything too crazy. It'll buffer the drawdowns. It will still go down, but if the market explodes higher, you'll still get a good return. And then you can pick away from that and choose the stocks that look good at particular times or whatever. So my generic kind of allocation would be that, just because you're not going to do too horribly, especially relative to the market, and you're not going to be left behind if the market just explodes higher. You're going to do just fine. That's pretty close to where I'm at if you took like all my investments, something like that. But I'm looking to buy with my investment accounts. But in order to have that confidence, you need to have your emergency savings. You can't have a ton of like high yield debt on your personal finances. So this is my message for the next 6 months or so, probably, maybe longer. I don't know. But I want to put this out there because I'm going to start doing a lot of individual stock analysis. And I want to have the context. I want people to have the context for what I'm doing. If I'm buying stuff, I still have my emergency savings for my personal finances in a different place. All right. Next videos will be about individual stock analysis. If you guys have any questions, put them in the comments. I'll answer them. Thanks for following, joining, watching, and I'll see everybody later.